Hi, we are from Group 5. Today we will be presenting our project on efficient diversification. Before begin, let briefly introduce my group members. I am Becca Ing, A194186.
I'm Lian Chuan, A195100.
I'm Dan Chai Hong, A196254.
I'm Dan Le A195479.
I'm YING, A195918.
For our project, our group top 4 companies including PPB Group Berhad, MISC Berhad, IHHLK, and KLCC Property Holdings.
This Excel spreadsheet shows the analysis of PPB's stock performance based on historical weekly data. First, from column A to column G, we have the given information about PPB's stock prices. This includes the date, price, opening price, high and low prices, trading volume, and the percentage change for each week. In column H, we convert the percentage weekly return into decimal form. Next, in column I, we calculate the excess return. This is done by subtracting the effective risk-free rate per week from the weekly return. The effective risk-free rate per week is derived from a government bond yield of 3.18% per annum. The formula used is take 1 plus the annual interest rate of 0.0318, raise it to the power of 1 divided by 52 to convert it to a weekly rate, then subtract 1. After that, we calculate the annual return by multiplying 1 plus each weekly excess return from cells I3 to I54 using the product function, then subtracting 1. Next, we find the standard deviation of PPB's excess returns using the standard deviation function, followed by the variance using the variance function. We then calculate the covariance between PPB and the other companies. For PPBs and MISC, we use the covariance function with excess returns from cells I3 to I54 and I59 to I110. The same method is used for IHH and KLCC using their respective range. Finally, we compute the correlation using the correlation function. For PPB and MISC, we use cell I3 to I54 and cell I59 to I110. The same PPB range is used when calculating correlation with IHH and KLCC, along with their corresponding excess return data. Next, we apply the same steps to calculate the annual return, standard deviation, variance, covariance, and correlation for MISC, IHH, and KLCC using their respective excess return data.
The expected exit of return for each company is obtained from the previous calculation. Now we are going to form a covariance matrix for each of the 4 companies. For example, the value 0.000112896 is the covariance between the PPB and MISC. Then we sum out all the covariance in each column and then sum it together will give us the variance of the portfolio. Then square it to get the standard deviation of the portfolio. Next, the expected risk premium of the portfolio is the sum of the 4 expected exits of return with their corresponding weightage of the company. Last, the Sharpe ratio is obtained by the risk premium divided by the standard deviation of the portfolio. Next, we are going to compute the minimum variance of the portfolio by using Excel solver. Now, set the target for the standard deviation of the portfolio to be minimum. The changing variable is the 4 weightage of the company and set a constraint for it. Make sure the sum of the weights of the 4 company is always equal to 1. Then, by using Excel solver, it will give us the corresponding weightage of the 4 company for the minimum variance of the portfolio. Next, the maximum Sharpe ratio of the portfolio is also same as previous. The only different part is the target cell. Set the Sharpe ratio to be the maximum, And then by using the solver, it will give us the corresponding weightage of the four companies for the maximum Sharpe ratio of the portfolio. After getting the minimum variance and maximum Sharpe ratio of the portfolio, we set a range of the risk premium from 0.06 to 0.6 by using solver. Same as previous, the only different parts is the target cell. Change to the risk premium and set it to a certain value. After that, the solver will give us the corresponding weights of the company according to the value of the risk premium. Arrange the portfolio according to the risk premium by ascending order. Then the capital allocation line is obtained by multiplying the corresponding standard deviation of the portfolio to the highest Sharpe ratio, which is 14.877 for each portfolio. It will give us the capital allocation line. We form the graph by setting the risk premiums as our y-axis and standard deviations as our x-axis for both efficient frontier and capital allocation line. In conclusion, the portfolio with a higher Sharpe ratio, which is the 14.88, achieved using the corresponding weights of the four company share, PPB, MISC, IHH, and KLCC is identified as our optimal risky portfolio. This portfolio offers the best risk-return trade-off and lies on the efficient frontier tangent to the capital allocation line.
We calculate the portfolio expected return using the sum product function in Excel. We multiply its stock expected return by its portfolio weight and then add all of them together. We get the portfolio standard deviations by summing the cells E7 to H7 and then making the square root of the sum. Finally, the portfolio has an expected returns of about 0.39 and a standard deviations of 0.023. We get the weight in risky by taking portfolio expected return minus the risk-free rate, which is 0.0318, then divided by A times variance of portfolio. We get weight in risky is negative 218.9235. We then get the weight in risk-free by using 1 minus weight in risky. We calculate the expected return of complete portfolio by summing the weight in risky asset times with expected return of the risky portfolio and the weight in risk-free asset times with risk-free rate. The standard deviation equal weight in risky asset times with standard deviations of risky portfolio. The utility using complete portfolio expected return minus 0.5 times x times complete portfolio variance. We use the risk aversion coefficients A equal to -3, which shows the case for a risk-seeking investor. This type of investor prefers risk and is even willing to accept lower returns for more risk. As seen in the table, the required return drops from about -39.19 at risk equal to 0 to around -39.57 at risk equal to 0.5. This results in a downward sloping indifferent curve, showing that the investor gains more utility from higher risk even with lower returns. The risk-seeker investor heavily short sells the risky asset and over-invests in the risk-free asset. This aggressive and unconventional strategy leads to a high loss and a very low utility. The behavior reflects irrational investment decisions due to the negative risk aversion value. Although they are willing to take high risk, the result is a negative return, highlighting that excessive speculations or leverage can lead to undesirable outcomes even for risk seekers.
This slide shows the result for a risk-neutral investor, where the risk aversion coefficient is A equal to 0.01, which is almost zero. We don't use A equal to 0 exactly because it would cause a division by 0 in the weight formula. For this type of investor, only the expected return is important. Risk is not a concept. As shown in the table, the required returns stay almost the same, which is around 11,767.59, even when the risk increases from 0 to 0.5. This results in a horizontal indifferent curve, meaning the investor does not care how risky the investment is as long as the return is good. The risk-neutral investor allocates an extremely large proportion to the risky asset, borrowing heavily negative weight in risk-free asset. Their primary goal is to maximize return regardless of risk. While the expected return and utility are very high, the level of risk is extremely large, making the portfolio impractical in real-world investing. This shows that risk neutrality can lead to unstable portfolio choices if not properly constrained. This slide shows the case for a risk-averse investor, where the risk aversion coefficient A equal to 5. These investors dislike risks, so they want higher return to make up for taking on more risks. As seen in the table, the required return goes up as risk increases. For example, it's about 23.57 when risk is 0 and goes up to 24.19 when risk is zero point 0.5. This gives an upward sloping indifferent curve, showing that the investor will only take on more risk if they get more return. The risk-averse investor takes a moderate and balanced approach, leveraging slightly but staying within a more reasonable range. The result is a good expected return, low risk and positive utility, indicating an optimal portfolio for someone who prioritizes risk control alongside growth. This is the most rational and sustainable investment behavior among the three. That's all from our group. Thank you.